During our last video, we looked at real estate investment trusts, or REITs, and compared them with investing in commercial or residential rental properties. In this video, we will complete an analysis on some of the largest REITs that are traded on the US and UK stock exchanges, and compare them with real examples of residential and commercial property deals that are currently on the market. This will help us to identify which investments make more sense from a financial perspective. So let's complete the second installment of our real estate series on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes, from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. With that said, let's commence with today's video. So let's get started by doing a review on some of the most reputable REITs on the market. The first company we will consider is Slough Estates Group, better known as Segro, who are listed on the FTSE 100 index. Segro are a UK-based REIT and a leading owner, asset manager and developer of modern warehousing and industrial property. The company has over £12 billion of assets under management and has a broad geographical coverage across the UK and Europe. Some of its biggest customers and tenants include DHL, Amazon and the Royal Mail. Now, let's look at Segro's numbers. We've chosen investment ratios here that are pertinent when analysing a REIT. The first is the price to funds from operations ratio, or price to FFO. This ratio is considered by many experts to be more reliable than the price to earnings ratio when analysing a REIT. Segro currently has a price to FFO of 12.1. We'll later see how this compares with other REITs. Next, let's skip to the debt to EBITDA ratio. We prefer to use this ratio as REITs tend to have large sums of equity in their properties, so debt to equity ratios can be low and therefore don't tell us a great deal about how a REIT is performing. Like debt to equity, the debt to EBITDA should be a low value. Segro's debt to EBITDA 2.45 seems low, but we will compare this with the other REITs shortly. Next, let's look at the interest cover. Segro has an interest cover of 27, which looks high, and we'll compare that with the others shortly. In terms of share performance, Segro's share price is up 136% over the past 5 years, so has more than doubled in that period. Over the past year, its share price has increased by 9%. Segro's current dividend yield is 2.5%, and they have a dividend cover of 3.83, which is decent. Segro's price to book ratio is 1.08. We like to see PBs at 1 or less, so this is also reasonable. And finally, a reliable way to analyse the intrinsic value of a REIT is to measure its net asset value per share. Segro has a net asset value per share of £7.90, which is lower than its current share price, and this means that it may be overvalued. Next, let's move on to another FTSE 100 stock and REIT, and that's the British Land Company plc. British Land is one of the largest property development and investment companies in the United Kingdom. The company has approximately £11.9 billion of assets under management, and its portfolio mainly comprises of retail units, shopping centres and offices. Looking at British Land's numbers, we can quickly observe that this is a business with declining revenues and returns. Price to FFO and debt to EBITDA are both negative due to last year's pre-tax loss. Now, whilst this is mainly attributed to a large drop in high street sales, we can also see that British Land's 5-year performance is also down by 39%, highlighting a decline in the retail and office space sectors, as evident in this table shown here. 24% of the share price decline has occurred over the past 12 months. One positive note here is that British Land has a good dividend yield, and its net asset value per share is currently greater than its share price, which means that it's currently trading below its fair value and has potential upside. The next company we will look at is Equinix. Equinix is an American multinational REIT that specializes in telecom assets and data centers. The company is a leader in the global co-location data center market, with 210 data centers in over 25 countries. In 2017, the company launched its own data center infrastructure management platform, IBX SmartView, and the company has over $25 billion of assets under management. When we look at Equinix's numbers, we can immediately notice that they have high price ratios across the board. High price to FFO, high price to earnings ratio, and a high price to book ratio. So the REIT is relatively expensive. Their debt levels are also higher than that of their competitors. Equinix's 5-year share price performance stands at 300%, and this reflects the growth in the sector. Equinix's dividend yield is at 2%, and a low dividend cover of 0.61 indicates that its dividend yield is at a peak level, so we shouldn't be expecting this to increase anytime soon. Finally, its net asset value per share is 5 times less than its current share price, which is consistent with the high price ratios and indicates that this REIT is trading well above its fair value. Let's move on to the Howard Hughes Corporation, or HHC. HHC is a major real estate development and management company based in Texas that traces its roots back to Howard Hughes Jr., the famous entrepreneur. The company owns, manages and develops commercial, residential and mixed-use real estate throughout the US. The company divides its properties into 3 main segments: master plan communities, operating assets and strategic developments. HHC recently gained plenty of media attention when highly respected investor Bill Ackman increased his stake in the company to almost 25%. Now, let's look at the numbers for HHC. HHC's price to FFO and price to earnings ratios are almost identical, and both are relatively high at 30 and above. Their debt to EBITDA is very high at 35.5, and this corresponds with a low interest cover, and the two combined are never a good sign. The company has not paid a dividend to its investors in a number of years, which is unusual for a REIT, and we would need to investigate this further if we were planning to invest in this company. HHC's 12-month and 5-year share price performance are also very low. However, on a positive note, their net asset value per share is much higher than its current share price, which suggests that it's currently trading below its fair value. Let's now look at Welltower Incorporated. Welltower is a real estate investment trust that mostly invests in healthcare properties and medical facilities for the elderly. The company manages 1,200 healthcare facilities and has over $32 billion of assets under management. Welltower's price ratios are all modest and either in line or below that of their competitors. Debt levels are reasonable and interest cover is the second highest after Segro. Welltower has a decent dividend yield at 3.8%, but its dividend cover of 0.84 is concerning. Welltower's 12-month price drop of 27% shows a potential opportunity, especially when we consider that net asset value per share is currently lower than its share price. Finally, we will compare these companies against the SPDR XLRE ETF, which is one of the leading REIT ETFs on the market. And this will inform us on whether the ETF is a better investment than an individual REIT. The ETF represents most of the REITs that we have analysed in equal proportions, and this is reflected in its share price and performance ratios, which straddle across the highs of industrial REITs, mid-range of health REITs, and declining performance in retail and offices. On completion of our fundamental analysis and intrinsic value analysis of these REITs, we've given the following scores to each REIT. And you'll see that Segro has been given the highest score amongst all of these companies. So next, we will compare Segro against two rental property investments that are currently on the market using existing data. Under current market conditions, it's vital that properties are purchased below market value, and one of the best ways to acquire properties below market value is at auction. We have identified two properties that were recently sold at auction in December 2020 and listed on the Alsop's website, which is a leading property auction house in the UK. The first property is a 2-bedroom, ground floor converted flat in northwest London, which recently sold for £227 at auction. The property has a long lease and is currently tenanted, with the tenant paying an annual rent of £11,440 per annum. The second property is an A1 commercial high street shop in Milton Keynes, which sold for £242,000 at auction. The property is currently leased to Ladbrokes, who are a UK-based betting shop chain. The property was sold with a 999-year lease at a peppercorn ground rent. The lease on the property was extended for 10 years with a rent review period after 5 years. One thing to take note of here is that the annual rent was recently negotiated down from £25,000 per annum to £20,000 per annum. And this is a reflection of the current state of the commercial retail property space, which is currently in favour of the leasee. So it really is a buyer's market at the moment. So let's now complete an investment appraisal of these properties and compare this with Segro. Let's start by first establishing our assumptions on this investment. Firstly, let's assume that we place a 25% deposit on the property. Next, that expenses, including mortgage interest payments, make up 40% of the annual rental income, and that net rental income makes up the other 60%. And finally, we'll assume that the rent on the residential property has an annual growth rate of 2%. For the commercial property, we'll assume that the rent will remain unchanged for the whole 10-year lease period. There are three numbers to consider when completing an investment appraisal across different asset classes. The first is the gross rental yield. This is the number that is commonly used to quickly assess the yield of a property, and is simply the annual rent divided by the purchase price of a property. The second is the net rental yield, which is the annual rent minus all expenses divided by the purchase price of the property. Note that net rental yield is the value that should be used when comparing the dividend yield of a REIT with a rental property. Finally, we will use an internal rate of return, or IRR, to compare the different investments. The IRR tells us the annualized rate of return that we can expect from this investment. In essence, we're looking for an IRR greater than 10%. One important thing to take note of here is that when we use our IRR, we're only considering annual cash flows through rental income and dividend income. We're not factoring in capital appreciation of the asset. So when we compare all three investment options, we notice that the residential property has the lowest net rental yield, but that the REIT has the lowest IRR, which is negative at minus 14%. Now, the reason for this is the same point that we raised during our first video, which is leverage. Our personal investment in the rental properties only requires 25% of our money, as opposed to 100% that would be required for REIT. And this makes a significant difference when we consider our internal rate of return. And it's in this area that rental properties really do outperform REITs and stocks. The commercial property has an IRR of 15%, which is good, particularly if we are guaranteed 10 years of income without having to complete any expensive upgrades to the property. It's worth mentioning that if we were having to renovate the property, we'd be seeking a higher IRR, one above 20% typically. So to summarize, rental properties will usually outperform REITs, stocks and bonds when we compare them from a numbers perspective. And this is due to the fact that an investor is only required to invest a portion of their money to realize significant gains from the appreciating asset. Now, one of the few asset investment classes that can compete with this are options. However, options come with considerably more risk when traded as either naked calls or naked puts, so they really don't compare either. Now, of course, we're ignoring non-monetary factors here such as time, effort, and market sentiment. However, if you're a keen property investor with sufficient capital, rental properties, and specifically commercial rental properties, are a sensible investment choice. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, please subscribe to the channel and check out our website. We look forward to seeing you on the next video.